Hello friends, we are going to discuss with you physical stimulus versus monetary stimulus. These are two things in economic growth. Physical policy measures stimulate demand side of the economy, while monetary policy measures stimulate the supply side of economy. Demand side of the economy always meets at the higher level with the supply side of the economy to get a higher growth level. But when supply side of economy is too higher to demand side of the economy, the result is different. Fiscal policy measures take a lead role in economic growth with the support of monetary measures. Here, fiscal policy measures always stimulate demand side of the economy. But it is a support of monetary policy also to boost up economic growth. The hard fact is the demand side of the economy has a backing of higher velocity-led cash transaction, while supply side of economy has a backing of lower velocity-led credit transaction, which stimulates economy and supply side with a lower and lower level, and it takes time to stimulate supply side of economy. Here, government or physical policy measures always take a lead in economic growth. But there is something which lacks, and that is the supply side of economy or monetary policy of economy. Here, physical policy although takes a lead role, while economy needs production, productivity, and capacity and productive capacity, which needs to be boosted up for economic growth by riding on the higher velocity-led cash transaction. But in Indian economy, we see that government, instead of leading for economic growth, has hidden itself behind monetary policies. This is unfortunate. Here, virtually, the demand side of economy has started to support the supply side of economy, and the result is different than higher economic growth rate, because demand side of economy, and you may say fiscal policy or fiscal policy makers or government, it is a duty of the government to boost up economic growth. But neglecting their duty, the government has hidden behind the supply side of the economy and demand side of the economy has been neglected, and its result is what we are facing today. The Reserve Bank of India, or RBI, comes forward to influence the government. Seeing this favorable situation, government has hidden itself behind the RBI. And RBI monetary policy measures are being framed by government indirectly. Here, remaining behind the monetary policy makers or RBI, government starts fixing the monetary targets. Government dilutes the rules about financial institutions. Government also dilutes the RBI framed rules like prompt corrective action and insolvency and bankruptcy code. Here, government has also dumped a lot of credit and cash liquidity without any frequent cash transaction into the bank accounts. Further, government has also introduced bond recapitalization by replacing capital recapitalization in the recapitalization of public sector banks. Public sector banks are now being recapitalized by bond recapitalization, where there is no cash outflow and there is no cash transaction. The transaction takes place between government and the financial institution, particularly banks. So government fully comes behind the supply side of economy to support supply side of economy by sidelining its duty as a demand stimulator. Here, demand stimulation is needed, but government has hidden itself to support the supply side of economy by remaining behind the RBI. Here, with the adoption of bond recapitalization, there is no cash outflow, and here banks feel disturbed, and it has become a burdensome for the banks, because banks always prefer to hold the assets of longer period, because assets of shorter period in the midst of continuous interest rate cut for longer period brings a lot of problem for banks. Firstly, government loses slowly in interest income earning or net interest income earning. Secondly, government loses fixed income capital gain also. Thirdly, banks return on distressed asset has become the lower and lower. And in this situation, banks are highly distressed and they are facing capital crunch, while economy is facing demand crunch. So both supply side of economy and demand side of economy both are in a distressed situation because government as a stimulator of demand side has started to support the supply side of economy to remain behind RBI. Thus, government or fiscal policy measures, fiscal policy makers subdued attitude against monetary policy makers and RBI, or in other words, you may say that demand side of the economy or subdued demand side of the economy against supply side of the economy has brought a lot of problems with the banks, with the financial institutions, RBI, and finally on the economy. And ultimately, it is consumers, lenders, borrowers, all are facing a distressful situation. In this situation, government should pay attention to these things and come forward as a demand stimulator because fiscal policy measures' role is to stimulate demand because this is a demand stimulator, while RBI as a monetary policy measures frames rules to stimulate supply side of economy, which are mismatching, and Indian economy is facing disturbed situation where there is capital crunch, there is demand crunch, there is purchasing power crunch, there is a declining growth rate, appreciated rupee, and other things. This is my analysis, and I have presented this analysis before our viewers, our economists, and financial institutions and government of India and other viewers to think properly and give suggestions to the economy in a proper way. Thanks, a lot of thanks, viewers.